Welcome to Share Talk, the only podcast where investors come first.
Hello and welcome to Share Talk. Today I'm joined by Angus Forrest, as CEO at Drumz, with the epic code DRUM, which I find extremely witty and memorable. How are you today, Angus?
I'm very well, Zach. Thank you very much for your intro.
Basically, you've just been on the in this current guise. You've just been on the stock market for a very short period. Announcement yesterday from Drumz. Could you just take us through that announcement from yesterday?
Okay, we've been on the market since the 1st of July, and this announcement of an investment in Acuity risk management is our first investment. And I think that investment typifies what we're looking for. What we're looking for is established businesses with revenues and profits which are run by really good people and technically excellent. That their products will be validated by use with blue chip customers, but their weakness is in commercializing their excellence. And this, we believe, is quite common with software companies. It's probably not only software companies, but my area of expertise is in software companies. And we look to make a number of changes and provide expertise in how to change and how to improve the business, the quality of the business, as far as the commercials are concerned, so that over a 2 to 3 year period, we are able to transform the value for the benefit of Drumz shareholders, as well as the existing shareholders in the business.
Right, and I mean, so to make it colloquial, you're really saying that the premise behind Drumz is that nerdy, techie people don't make good salespeople, and they don't really make good business people either. Let's say.
That's a bit derogatory about software engineers, but I think that when you start a business, it is hard to realise the true value of your product. It is hard to make customers pay a proper price, to focus on the building of the business, as well as building of the product and paying all the bills at the end of each month. What we're doing is relatively simple items, but combined together, they should be able to enable a software business to grow in size at least fivefold in a 3 year period, and we should be able to transform the value, because not only will the value be higher because of the scale, but it'll also be more profitable. It'll got more customers. It will demonstrate significant growth. All features which are very attractive to trade buyers.
Right. I just wanted to look at the RNS that you released, and I think the two key points which look positive are. One, that Acuity was actually acquired, was owned by Siemens at one point, and then the second point is that in terms of the deal, you're paying £500 million for 20% of it, and you could get a bit more, another 5% for another 125. But as a condition of the transaction, you will be a director of Acuity, which, I mean, seeing historical examples. Taking a minority investment in a company in any sector, if you don't have the control with that purchase, you tend to be a backseat driver. So you can't really change or control that situation. So that ties in with what you're saying.
I want to just correct one thing. Siemens never owned Acuity. There was a previous consulting business, which was owned by Siemens, bought by Siemens, and the people who ran that business left to found Acuity. They captured what they provided as consultants in the software, and that's how Acuity was formed.
Right. But I mean, I think I was hinting really that it's a blue chip purchase, it's a blue chip product, which is used obviously by big name companies.
That is absolutely correct. And what we like about one of the many things we like about Acuity is that many of the blue chip customers have renewed year after year, so they see a lot of value in it. And we have been pushing up the prices significantly, and we have not met resistance from customers about paying higher prices. We, as well as me being a director, we do go into this and all other businesses with a shareholder agreement, so that we are able to influence and stop things if they appear to be going wrong.
Right, and just to tie in with the other things that we see in the space in terms of tech investing companies, they tend to acquire assets which will require a lot of development, so that costs them a lot of money, or they acquire assets which don't actually produce any revenue, so they end up having to keep sort of putting their hands in shareholders' pockets to keep going. I mean, that's obviously something you're trying to divert from.
But we do not want to do that. Once we've put our investment in, we want the business to be able to continue without further investment from its own resources. In the case of Acuity, it has been profitable and cash generative, and most of these businesses will be cash generative because they're trading on a SaaS model, that's software as a service, whereby you get paid annually up front, and that's obviously very good for cash flow. Gross margin will be 90% or so, so almost everything you obtain from a sale is able to cover the overheads, which of course are substantial, but it does mean that we will not have to keep drip feeding these businesses.
Right, and then the final aspect is tech companies, again, tech investment companies tend to get bogged down with their assets. They have a portfolio, let's say 5 or 6 or 10 or whatever products, and they just keep acquiring more and never selling them. They're either not able to, or they feel the time is not right, or there's some other excuse. That's again something that you're going to shy away from.
My belief is that we should enable ourselves to obtain an exit route, whether that be by sale of the company or whether it be by an IPO. And I've had considerable experience of both IPOs and trade sales over the years, and that is where we're aiming to get the characteristics of the company in a shape to maximise the value over 24 to 36 months.
Right. So finally, you've been on the market a couple of months. You've done your first deal. What do you envisage the pace of deal making or deal flow may be?
I think we probably should try for doing 2 or 3 deals a year. We must endeavour to make sure that each one is a success, and we don't have unlimited resources. So there are really 2 of us working away, and if we take the pain up front, because normally the change is the most difficult to achieve, and that is right at the start. We could probably do 2 or 3 a year.
Okay, well that sounds like something for us to look forward to and keep an eye out for. Angus Forrest, CEO at Drumz, thank you very much indeed.
Thank you, Zach.
Thank you for listening. Remember to visit our website for more news and other podcasts at www.share-talk.com.